Today, what I thought I'll do is I'll walk you through the basics of how I pick stocks, what I look for. So, to know a little bit about me before we jump into it, currently I'm a popular investor on the website eToro. There, I manage, I think it's like 2.7 million US dollars. Well, that's not really managing, it's people copying me, opting in to copy my portfolio. So, the way it works is I create a public portfolio. People can transparently check every single one of my positions there. And if they choose to, they can opt in to copy my move. So, yeah, it's quite significant. I have been full time as an investor for about 8 years now. And I've been in the game for a total of about 12 years. So, I'm 32 now. Started like when I was 19, 20 ish, and I really haven't had a job since the age of 24. Anyway, let's jump into the video. What am I looking for? This is like the 20%, which gives you like 80% of the results. So whenever I'm looking at a company to invest in, usually I've heard about it from social media, or by watching YouTube channels, investing YouTube channels, say something like The Compound or something like All In. I highly recommend if you're going to subscribe to a couple of YouTube channels, those are the two. Those are the two that I practically only listen to. Other than that, I try not to listen to too much these days. Otherwise, it's just like mental overload, and you're just getting bombarded by too much information. So I've gone through hundreds and hundreds of different people. These channels are the only two channels that I kind of trust, and yeah, usually they're pretty spot on with what they're talking about. Obviously, they do get things wrong. So usually I hear about something first from these YouTube channels, then I go and check it out. But sometimes as well, like you just notice it in your real life. So today, what we're going to be doing is focusing on Amazon and understanding Amazon. Now, I first take the approach that if I am not the CEO of the company or an executive of the company, I actually can't understand the company fully. I would say even with all of my research, um, you probably only understand like 10%. And that's not based on, hey, I'm not smart enough to understand the company. It could be a little bit of that, but looking at myself, I believe I'm pretty damn intelligent. I'm pretty good at what I do, but it's based on just mental time spent thinking about the thing. Like, imagine if you're a CEO of a company, if you're the CEO of Amazon, all you do is think about the company. So you know where the company's heading. You understand every single aspect of the business. You can't do that unless you are the CEO. So I'm taking a humble approach of saying, hey, I actually don't really know everything about the company, and I'm okay with that. Now, that leads to the next thought that I look for the leaders, and I look at it from like a psychological perspective. So I check the leader, like I look at, so let's say back in the past, the founder of the company was Jeff Bezos. I listen to heaps and heaps and heaps of interviews of Jeff Bezos. And what I'm trying to do is filter out, is this guy smart, intelligent, trustworthy? And is he switched on and does he have a correct vision which would make sense for the long term? Is he thinking long term? Yes or no? So I take it more from like a psychological perspective, and the way I like to filter through is like, I look at myself, I say, hey, I'm pretty smart, but I'm not that smart. I compare myself to that person. And if I can say, hey, they're pretty much smarter and harder working than me in every single area of business, then that's a major tick of approval for me. So a big part of my strategy is looking at which companies are the market leaders ran by great teams. And if they've really switched on, I'm saying, hey, they can probably run a business better than I can. I wouldn't mind parking my capital with them because, again, it comes back to psychology, which is skin in the game and game theory. If someone has become a billionaire through growing their company because they have so many shares in the company, they started it, they are probably motivated to keep that company growing um, for as long as possible. And you know those people, like if you become like the market leader of a segment, You probably are extremely, extremely competitive. And it's actually very hard to understand what is going through these people's mind. Like, people like, David Goggins, the runner, the ultra marathon runner. He's very popular. Everybody understands his mindset, right? It's quite simple to understand because running is running. We've all done running before. But this guy's pumping out 40 kilometers every single day like it's nothing, right? And then he does these 200-mile runs, and I don't know, he's probably ran more than that, these races, right? That takes a certain level of mindset to be like that. Am I like David Goggins? Not even close. Now, these David Goggins figures, they are also in the business world. It's our job, I believe, to try and find these people. And I want to bet on them because if we were going to do a running race, why would I bet on myself if David Goggins is in the race as well? I would rather park my money with David Goggins, bet on him winning the race, rather than betting on myself because I know I am going to lose. So that's how I start off. Check for, are they the market leader? Is the management team switched on? And I'm looking for psychology, like, when they speak, are there any red flags like they are a scam or they're lying? Um, and I also recommend checking out companies that turned out to literally be scams. There's many examples. Go research them and then look at how their founders speak. Like it's a little bit, usually, a little bit too cult-like. They may be speaking in language which it sounds sophisticated, but honestly, it's like sophisticated for no reason. Like they're trying to hide something. So look at how they talk. Usually, the best CEOs talk in a very simple manner. A person you can look at for who speaks very simply is actually Donald Trump. You know, if you look at how Donald Trump speaks, it's like he's speaking to someone who is like the age of 10, right? So that's actually a major green flag if they speak very simply because they're not trying to hide anything. So I first start with that. And then I want to understand the vision and I want to understand the bull case of this company. And I want to be able to summarize it practically in a paragraph, right? What is the bull case? And there's probably like 10 bull cases. There's 10 different aspects of the business, which is going to make it extremely successful. But I want to see one, which is like, this is the 20%, going back to 80-20 principle analysis. This is the 20% of the bull case, which will give like 80% of the results. And again, it is very, very easy to understand. So if we look on to this chart here, by researching a lot about Amazon, I came and this is what I found. So I don't know if this chart is 100% accurate. I'm not even sure if there is any data where we know for sure it is 100% accurate, but it doesn't really matter. The data doesn't have to be exactly accurate to understand the bull case. So let me explain the bull case to you. Amazon is growing extremely quickly, right? It's been growing extremely quickly for multiple decades at this point. And then if a company is growing extremely fast, what are they likely to do? They are likely to be hiring more and more employees, right? So I want to see an employee graph be going up practically exponentially, right? And on this graph here, I don't know, I like to see the exact numbers. It's like in the tens of thousands, maybe close to 100,000. Just eyeballing, it's hard to tell from the graph. That's back in 2013, and it grows to like around 1 million employees. This is for the employees that are specifically inside of the fulfillment centers at Amazon, like the actual warehouses. Obviously, that is the major part of Amazon is the warehouses, right? Sending the packages to us, customers. So it looks like, yeah, roughly around 100,000 staff members in 2013. And then it grows all the way to like probably just under 1 million-ish in 2020. That's in like 7 years. So it's like a 10x roughly in the growth rate of the employees. That's a lot of costs involved. You wouldn't, remember coming back to game theory and skin in the game, you wouldn't hire all those people for no reason. Okay. That's going up and it's pumping. Then here there's a red line, which is the robots. So Amazon acquired a company, right? So these companies, these big companies, they're actually always in acquisition mode where they're looking to buy a company which has, they have a mutual benefit. So Amazon bought a robotics company called Kiva Systems, and they're responsible for a big portion of the robotics. Again, I don't know the exact specifics. I haven't looked into it to that amount of detail, but again, I don't think it's that really important. Now, if we look at the graph, 2013, there's like no robots. 2014, barely any. You can't even see it on the chart. 2015, all right, there's a little blip. 2016, a little blip. 2017, a little bit more again. And then 2018, the hockey stick starts. Now, 2018, it's pushing. And then in 2019, there is, for the first time, more robots in the fulfillment centers than there are employees. And the two lines, they kiss. When you're looking at graphs, you want to see the two lines that have the little kiss, right? Little smooch. It's a big day when they smooch and they cross over, all right? Why is this so big? Because a robot, let's just say like, oh, let's start with an employee. Employee, let's say they work 40 hours a week roughly, and they get paid like 50 grand a year, okay? Now, that employee needs to have breaks, needs to have time off, and needs to have all those things, right? Holiday leave, all that stuff. Whereas a robot can work 24/7 non-stop, right? So imagine if the robot cost $50,000 as well. That means after 1 year, you break even on it, and then the robot is just pure upside from there. But that's actually a lie, right? Because a robot, I just said, a robot can work 24/7. A human can't. So that means you need two humans at least. Maybe even three, because they're only doing 8-hour shifts, right? 8, 16, 24. You probably actually need three humans. That means there's $150,000 of labor cost compared to a singular robot. Now, obviously, there's extra costs in there. The robots are probably going to break down every now and then. You've got to charge them up. But you can see the math very simply works out very, very positively. So then you can see the next year, what happens? The robots go insane, and it's like double the humans in the fulfillment centers. Why again? Like, can we just trust this? Like, it's in the game. You can see how they are thinking from the data, and just by understanding, and at the end of the day, by doing that research at the beginning, listening to the founders and the management team and all that, you can find a way to trust them. Now, you can't trust them 100%, and sometimes they're going to make mistakes. But if you make a diversified basket all of these great investments, these great companies, you're probably going to end up winning, right? You're probably going to end up winning. And yeah, maybe 10, 20, 30% of those companies might fail, but it doesn't matter because the upside is unlimited. Like, in investing, that's the beauty of investing. If you're going long, meaning you're buying into a company, it can go up 10%, 100%, 200%, 1,000%. Whereas the downside is limited. You can only ever lose your investment, which is 100%. So if you had a basket of 40 stocks or whatever, the market leaders in all of these different segments, especially technologies that are going to revolutionize the world, it's a pretty sure bet you're going to make a whole lot of money. So that graph there, you don't have to be a genius to understand. If the numbers are off a little bit, who cares? They could even be off a lot. Who cares? Maybe the kiss hasn't even happened yet. Maybe the kiss is coming next year. It doesn't matter. We know that's the trend, right? We don't need to know the data, and it doesn't have to be 100% accurate in this, okay? Now, next, what I do is I jump over to the website called Macro Trends. The Macro Trends is a great website to understand the financials of companies. Again, I'm not like Warren Buffett. That is not my edge. So I'm not going to try and look at all the financials very, very specifically. I just want to understand the bull case very, very quickly. So what I'll do in Amazon's case is I'll go Amazon and I'll click on revenue. And then let's just see. All I want to see is the revenue is absolutely pumping, right? You click on all and see the whole history of Amazon and look at it. At the start, it's like 24 bill. It's growing 60, 80, 100, pumping, right? 500 bill, 670 bill today, right? Huge. So we can see that line is going up, right? Who are the competitors of Amazon? I don't even know, right? In Australia, I don't even know. Then let's go to net income. Net income, whoops, close this one. What are you doing? What you got to add? All right, net income is the actual profit. I want to see that the profit is also going up. And if they're not profitable, I want to understand, is there a case which they can turn profitable very quickly? Now, same thing with Amazon. They had barely any, 1 bill, 1 bill, 1 bill, under 1 bill, a little bit negative, doesn't really matter, around 1 bill. They're single digit billions. And then all of a sudden, it starts kicking up. When does it start kicking up? It starts kicking up at the same time as the robots start getting implemented. Now, is that 100% because of the robots? I don't really know. But to me, it kind of makes sense, right? Until today, it's up 70 billion. 1 billion at the start, trailing 12 months. And that's back in 2010 to now 70 bill. It's a 70x, right? Big numbers. I recommend you do this exercise with all the companies you are familiar with. Do it with some standard companies. They're not going to be going up 70x, right? And everyone thinks like, hey, Amazon, yeah, maybe it revolutionized the world back in the early 2000s and 2010 and all of that. It's still cranking, right? It's now, in a weird way, become like a boring business. It's become boring, right? Everybody's looking at AI and crypto and all of this. These are the blue chips of today. These are the blue chips of today, and they're not slowing down. Look at this graph. Does it look like it's slowing down? I don't think so. All right. Now, after I'm done with those two simple exercises, I then move on to opening up the software trading view. And all I want to do is just very simply, like, you can ignore these lines that I've put on here. That's a little bit of technical analysis. I use a little bit of technical analysis, but usually very simply, I just want to see, is there a nice trend line, this green one, a nice trend line where it's just pointing straight up and to the right. And often with the best companies in the world, you can just look at all of these dips and you can very simply just line them all up. It's really weird how the stock market works. It follows these weird patterns, which, I don't, they do, like, I don't know, like when the market's crashing, they come down to them perfectly. Again, they give them a little kiss, give them a little kiss and a bounce, and off they go. Like, how does this work? Like, I can't fully explain it, but I think it's kind of like a self-fulfilling prophecy. A lot of investors are thinking like I am thinking right now. So when something is correcting, they wait until it comes back down to this trend line. Like, hey, in the past, it's bounced on this thing. Every time it's kissed it, boom, she goes. What are the odds that it does the same this time around? Maybe quite high. Now, it doesn't always work out like that. Sometimes you have to readjust the line and all of that. But again, going back to portfolio theory, if you had a basket of 40 investments, a whole heap of them will follow the trend for longer than you expect. Like, they could be following it for 10, 20, 30 years in many, many cases. So is this chart going up and to the right? Is it getting supported by a major long-term, multi-decade trend line, yes or no? In this case, definitely yes. All right, another tick of approval. That's all I want to look at, all right? I want to look at the charts like I, again, am a 10-year-old child. A 10-year-old child can see, hey, this thing's making money. It's going up. And again, remember, it's confirmed by our exercise that we previously did. After that, I just want to know, like, all right, this is all great and all of that, but what has actually been the historic returns for investors? So then I go over to this website here. It's dqydj.com. It's a stock total return and dividend reinvestment calculator. So it calculates, if you were to invest at a certain date into this stock of any sort, how much money would you have actually made? What is the actual compound rate? What is your ROI of the investment? Taking into growth, usually stocks are mainly growth. The stock price going higher and higher, higher. But the beauty of this investment calculator is it also calculates for any dividends reinvested into it also, right? Now, Amazon, let's just type it in. Ticker symbol AMZN. Boom, we click that. I like to just go with the default, like $10,000, start amount $10,000. It's a nice number, nice whole number, so it's easy to do the math. And then by default as well, it does like the last 10 years. And I like that as well. I want to see how it's performed over the last 10 years at least. That's my investment style. I'm not trying to look for all these new IPOs and all these new hot things. I don't care about that. I want to see a big dog, like this big boy that is the winner. It's the Goliath, and it's going to keep on growing faster and faster and faster. And it's going to shock everyone how big the Goliath can actually become. All right, now let's calculate this return, have a look at it. And then, yeah, it goes through and it checks everything. And then you can see if you were to invest $10,000 into Amazon 10 years ago, you would have 83,200 today, which is an annual return of 23.58%. So it's above 20%. Now, what we're looking for with these annual returns is you really want to make sure it's drastically outperforming the S&P 500. The S&P 500 on average is around a 10% annual return. So this is more than double. That's kind of like the benchmark that I'm looking for. I want to see things that are growing at more than 20%, which is really outperforming the S&P 500. Again, because there's now a room for error. Going back to portfolio theory, maybe not all of them can keep growing at this rate. And maybe even Amazon in this case, it starts going down to 22 and then 21 and then 20, all right? We can assume that as well. But our job as investors is to outperform the S&P 500. That's our job. That's the benchmark. Now, if you can make uh, better returns than the S&P 500, you will become hilariously rich. Hilariously rich. Um, even if you only get the 10% return, if you sacrifice and put in a lot of money to something like the S&P 500 and you get those 10% returns for a long enough time horizon, you will become pretty hilariously rich as well. Like it's actually quite easy to retire with like 10. It is actually quite easy to retire with $10 million just with like the S&P 500. All right, so that's pretty much everything. That's like the 20%, which will give you 80% of the results. Bang, 20-minute video for you. Hopefully that's nice and easy to understand. Again, going back to the principle of sometimes the intelligence is in the simplicity. Thank you very much. I hope you found this video helpful. If you did, please share it with someone and please leave a like and a comment. Thank you very much.